Stock market crash 2021 preparation. Why the stock market will crash and burn, or not. Well, the year 2020 is finally, mercifully, coming to an end. And we are, for all intents and purposes, looking forward to the next new year, well, the next year, and all the hope that it will indeed be better than what we can all agree was the year from hell. But what if the year is actually worse? What if the stock market falls into the abyss in 2021? What will you do? How can you survive this upcoming market crash? We'll talk about the reasons why many people think that the stock market will crash in 2021. And we'll look at the counter arguments for why it could actually go up. Also, look at what you can do to increase your wealth no matter what the stock market does. So, gently and lovingly, caress that like button for the YouTube algorithm. And kick back and relax, because it's going to be great. But just in case you're meeting for the first time, you're watching Finance Squared. I'm your illustrious host, Derek West. And be sure to get more from this channel by subscribing and clicking that notification bell. But with that, let's get right into the topic at hand, the upcoming 2021 stock market apocalypse. So like I said, 2020 was quite the year. Let's take a look back at all the things that had happened. So like I said, 2020 was quite the year. Let's look back at that year and all the things that happened. But speaking of market apocalypses, March 2020 and the weeks and months that followed were quite the sight to behold. At no other time since 1929 have markets so sharply declined in such a short period of time. People were predicting that there would be 30% unemployment and that the Dow Jones would go to 1,000 and things like that. The good news is stock market experts are typically always wrong. And when they are right, it's typically by accident. The best ones just predict the same thing over and over again. And over a course of a couple of years and even decades, eventually their predictions become true. They can then say that they were right this whole time, and if only you'd listened to them 20 years ago, you could have avoided this whole mess. Pretty much everyone else, though, sort of goes from prediction to prediction based on the market position or the news of the day, predicting one thing or the next, and they're usually wrong. And then when the next big news item hits, they talk about that for a while and make predictions based on that, and again, they're typically wrong. And the whole cycle just kind of goes on like that for infinity. Meanwhile, you're scared out of your shorts and you never start investing. So let's help you break that cycle by looking into what actually happened in the markets during 2020. Well, the stock market rose, first of all. A lot of people don't remember the first couple months of 2020. For some reason, it was only a year ago, January and February. I do happen to remember that, mostly because I was kicking myself for not investing more heavily in Tesla than I already had. But the stock market was steadily rising through the month of January and into the month of February. As a matter of fact, the first couple of days and weeks of March weren't that bad either. But as we all know by now, during that period of time, the news on public health just kept getting worse and worse and worse. You started hearing about cases of that disease that shall remain nameless, and how it infected more and more Americans, and you just had the sense that the government had to do something. And something they did. And that caused the stock market to crash. On came the initial lockdowns, which we were told were to flatten the curve and to give hospitals a chance to catch up to the oncoming onslaught of patients that would inevitably be infected with this thing with much fanfare and with much, ability to not handle this thing. Meanwhile, businesses were shuttered and whole sectors of the economy were just taking it in the shorts. Many otherwise healthy companies, no pun intended, soon saw their profitability go through the floor. Companies like Boeing, let's be real here, Boeing was having problems even before the virus, and that said, the virus didn't help. But Carnival Cruise Lines, Disney, Southwest Airlines, American Airlines, all the airlines as a matter of fact, they were all in pretty terrible shape. And this of course affected their stock prices, and thus the market as a whole just continued to sell, sell, sell. We mentioned the big ones, Disney, American Airlines, all airline stocks, Carnival Cruise Lines, commodities, particularly oil. Oil, for a time, briefly traded its future contracts negatively. Since the largest consumers of their products, airlines and cruise lines, were not going to be doing as much moving about as they typically would, and come to think of it, even smaller consumers of oil products, individuals using their cars and gasoline, they were not going to be able to travel as much as they typically would during this time period. As a consequence, oil just got hammered, meaning that companies that held future contracts for oil were literally paying investors to take that oil and those contracts and that inventory off of their hands. It was quite extraordinary and a testament of the times in which we all lived. But then it all changed, and the feds came to the rescue, starting with stimulus checks that were passed out to families and businesses affected negatively by the fallout of the shutdowns. Money was slowly injected back into the economy. Now this of course cured the problem that they more or less caused, but that's aside from the point. In addition to that, the Federal Reserve kept interest rates really low, working in conjunction with their counterparts in the government. Side note, little known fact, the Federal Reserve is a private bank. Close side note. But the Federal Reserve set and has kept interest rates at a low level, encouraging investment in and participation in the economy as a whole. Meanwhile, people did whatever they could to keep their jobs and work from home. And with all of this, the stock market and jobs started to come back. Keeping in mind that those are sort of the broad strokes of the measures the Feds took to prop up the economy, and they definitely propped it up. Over the next couple of months, both the stock market and the labor market continue to trend in positive directions. As a matter of fact, the stock market has completely rebounded and in less than 9 months was back to pre-crisis levels. And many economists believe that if the trajectory that employment has been on over the last couple of months continues, we should be at pre-crisis employment levels before a full year has passed since the lockdown started. And that's kind of where we are today, with almost an irrational euphoria in the stock market as the election seems to have cleared up, and this is causing the stock market to seemingly keep rising and rising. The question becomes, will it continue into 2021? A lot of people think maybe it can, but there are others that think that it will not. So, as you might imagine, there are two main schools of thought on this. There are the Bears, not the Chicago football team, tend to think that the market will go down, while their counterparts, the Bulls, not the Chicago basketball team, tend to have a rosy outlook on the stock market as a whole. Now, why are two investing philosophies named after lousy Chicago sports teams? I'm not sure. There's probably a good reason for that, and come to think of it, that might make an interesting video, if not somewhat off topic for this channel. But stock investing mentalities can influence how one positions themselves in the market. If you think the stock market is going to go down and down and down in 2021, then you're likely to sell all your positions now and get it while you still can with the profits that you made this year. Assuming you didn't sell at the bottom of the market, that is. And if you think the stock market is going to continue to go up and up and up, then you're likely to hold on to your positions and keep your money into whatever investment vehicles you prefer at this moment in time. More on those in a minute. But let's discuss the reasons that the stock market might go down. There are tons of them out there. And being Frank here, as opposed to being Derek, there are tons of reasons why the stock market could go down and not recover for a long time. One of them being unemployment possibly lingering at high levels. Now yes, it is true that unemployment has quickly dropped to not unreasonable levels, about 7%, in relatively short order. That stated though, the unemployment rate is still relatively high as compared to recent norms, which have been hovering at around 5% unemployment, which a lot of economists define as a healthy unemployment rate. And if that unemployment level continues to linger at a high level, that could further inhibit consumer spending, which is a large driver of economic growth, and frankly, stock market growth, particularly if there is no stimulus passed to help those that are still unemployed. Where is that stimulus money going to come from? Who knows? The magical US dollar fairy, I suppose. Nah, I'm just kidding. It'll be printed by the Federal Reserve, further destroying some people's confidence in the US dollar. I have a video on that particular phenomenon and what to do about it coming up very soon. In fact, early in the start of the new year. So, you know what to do. Smash that like button for the YouTube algorithm and subscribe and click that notification bell. But when people have jobs, they have money to spend. Not rocket science here, am I right? And when they have money to spend on consumer goods, then the stock market tends to do well. Although, that is not always the case. Remember, the stock market is a market just like any other market. You know, sort of like your Best Buy chain or your grocery chain or Amazon. Markets are filled with goods, but consumers and producers. Both consumers and producers are humans. Well, one would think. That might be changing at least on the producer side, however. I wonder, do you think the robo-apocalypse will also automate buying habits? Anyway, for now, markets consist of humans, either producers or consumers, and humans can be rational, but oftentimes they're just irrational, and they do inexplicable things. So what would seem like irrational market behavior is just really investors and companies behaving like humans behave. Sometimes being perfectly logical, but other times giving into the whims of emotions, particularly fear and possibly greed. You know, euphoria that your stock pick is doing so well, so hey, it's time to double down and buy more. Or fear that you're missing out, appropriately called FOMO, on the big run-up and getting in while the stocks are still hot. Or alternatively, fear that because the market is crashing, you know, like earlier in 2020, it's going to keep crashing and essentially go to zero, ruining your family and destroying all your life savings. Let me get out now before the whole thing burns to the ground. Well, there are reasons why people fear that the stock market will fall and never recover. But there are also reasons why people think it's going to keep going up and up. And like I mentioned earlier, we call people who think the market is going to go up bulls. Remember the unemployment number that I talked about and how it's keep getting lower earlier in the video? Well, that trend has been on a positive trajectory since April, when the worst of the shutdown started to end. Since the high of 14.5% unemployment recorded in April 2020, jobs have been added to the economy at a record pace. Some months with over 1 million jobs being added, and one month with over 2 million jobs added in that month. Like I said, that kind of job growth is unprecedented in American history, and possibly world economic history, and would represent a true V-shaped recovery from an economic panic. I've heard of such things, but I've never seen one for myself. And the thing is, if we're being honest with each other, this trend is likely to continue for at least the next couple of months. As you may know, since we're at the end of 2020, We are now officially in the holiday season. It's at this time of year that quite a bit of economic activity occurs. Various economists have different estimates for how much of a year's total economic activity happens during the holiday season. Let's just say that quite a bit, if not most, of the year's economic activity happens right around now. So what that means is job growth will continue to pick up steam all the way through till the beginning of the new year, at the very least. Other reasons for optimism include that a vaccine has been introduced that promises to inoculate folks from a certain infectious disease that shall remain nameless, but we all know what I'm talking about. A couple different vaccines, actually, with distribution to begin either later this year or earlier next year. I keep hearing different things from different people, who knows. But promising to help Americans get back to the old normal, and not this new normal that we've all come to know, and I guess sort of tolerate. All this could lead to at least markets not going wild and crazy like they did during 2020, when they rose slightly for the first 2 months and then took an enormous dip, at which point they quickly recovered and now we're going into unexplained exuberance. Any of this is true. Either the bull's position or the bear's position. What should you do? Keep in mind, this is just my analysis of the situation on the ground. Everything I said could go completely sideways. The vaccines may not work at all. Or even worse, they could cause other sickness. In addition to that, this could be the worst holiday season for the last 20 years. And unemployment could spike back up to 14.5% or worse. The truth is, no one really knows. And nobody can really predict these things with any degree of certainty. You really take your financial future into your own hands when you listen to the so-called investment experts and their prediction. Now, I was watching a video from Stephan and his channel on this very topic, and I was impressed with some of the research he had done on it. I was impressed with some of his research. For example, there's a study that claims that monkeys picking stocks did better than a particular index. It's long been known that picking stocks and timing the market is one of the worst ways to try and make money in stocks. Very few people can do that well. Very few people have the data points that they need to be able to do it accurately. And very few people can maintain the discipline that it takes to ignore your emotions in such a way to consistently pick stocks and time your investments so that you consistently make money. There are people who take and have those skills and capabilities and pick winners multiple times over the course of a career. But they picked a lot of stinkers as well. And most of those folks do not consistently beat the S&P 500 index. So you're better off investing in an index fund in a broad index that represents the whole stock market or a sample of it than you are on trying to time the market and get in at the bottom or get out at the top. And also supplement those safe investments with purchases in single stocks for companies that you believe in and that you have done long-term investment research on. Companies that you think will outperform the market as a whole. But let's say, for the sake of argument, that my analysis is completely wrong. The stock market is set for a long, slow decline throughout 2021. Well, that means that stocks are cheap, and they're going to be getting cheaper, which means that it's a good time to buy. Think about it for a second. We just went through a Black Friday, right? What were scores and scores of people doing at store chains around the country? They were buying gifts and trinkets for themselves and family, or really just themselves, because more than likely, they saw that these things were on sale, and they could get a great deal. Now, was that big screen TV really on sale? That is questionable. See my video on how to stay in the black during the holiday season for more info on that topic. But the point is, assuming the stuff you bought was really on sale, you purchased those things at a discount and can now enjoy them cheaper than you would normally. Stocks and other investments are the only things that people avoid when they're on sale, which is again, not rational, but it is human. So buck the trend. And when stocks go on sale, i.e. there is a massive stock sell-off, buy more, not less. And for heaven's sake, resist the urge to sell, sell, sell. Now, of course, there are a couple of caveats here. This is assuming you're not heavily invested in a highly speculative position, like a penny stock that your cousin suggested to you, or you're purchasing stocks using this month's mortgage payment, or heaven forbid, you're purchasing stocks with borrowed money. All of those I would suggest you do not do at all, frankly. Don't worry, I have a video coming out on investment strategies that you should follow that will help to keep you on the straight and narrow when it comes to investing. So, like and subscribe. But when it comes to the impending stock market crash of 2021, just do the smart thing. Keep buying diverse market-based instruments and investing in long-term company positions that you believe in. Because with the average 9% growth in the stock market that has occurred since World War II, that has occurred no matter which political party is in office, in the long term, you're sure to succeed. Unless, of course, it all goes sideways. And with that, I'm gonna split. Thanks for watching, guys. And remember, a goal without a plan is a wish. And a goal with a plan and no action is a wish list. So be sure to take action on your investments and don't fall for your emotions when it comes to investing. And I'll catch you next time. Peace.